Today, throw a little more liquidity on the Barbie. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and prop news with a distinctively Australian flavour. In our latest daily update, we're going to go through some of the key developments from around the world and specifically look at what the Reserve Bank has done here today in terms of cutting the cash rate and quantitative easing. And of course, as the crisis deepens, the efforts around the world to try and save the global economy also rise. So first thing to note is that the ECB launched a €750 billion pandemic emergency purchase programme. The Governing Council decided to launch a new temporary asset purchase programme of private and public sector securities to counter the serious risks to the monetary policy transmission mechanism and the outlook for the euro area. This new emergency programme is €750 billion. Purchases will be conducted until the end of 2020 and will include all asset categories eligible under the existing asset purchase arrangements. And then they also expanded the range of eligible assets under the corporate sector purchase programme to non-financial commercial paper, making all commercial paper sufficient credit quality eligible for purchase under the CSPP, and to ease the collateral standards by adjusting the risk parameters of the collateral framework, in particular to expand the scope of additional credit claims to include claims related to the financing of the corporate sector. This will ensure that counterparties can continue to make full use of the Eurozone's refinancing operations. So, in essence, this is an attempt to put more liquidity into the market and specifically to help support corporates in the Eurozone. And then we had a very interesting development when General Motors offered to manufacture hospital ventilators in auto factories shuttered. That echoes World War II contributions from Detroit, says Bloomberg. And of course, the UK Prime Minister Boris Johnson earlier this week called on manufacturers to build ventilators, including Jaguar Land Rover and Toyota Motor Company. And then we had Tasmania announcing that from midnight Friday the 20th of March, all essential travellers departing for Tasmania will be required to quarantine for 14 days. And that was announced by the Premier, Peter Gatwain. This is tough, he said, but a necessary decision to flatten the curve, putting Tasmanians' health and well-being first. And I also published a blog that specifically asked the question, why will property values fall? And I said that despite the property bulls, who seem to be a bit quiet just now, there are a series of logical reasons why prices will indeed fall from current levels. First, net migration into Australia will stop, full stop. We have been seeing around 300,000 each year, which was one factor supporting demand in some areas. Second, new property transactions will stall. No one will want to attend an open house, yet alone an auction in the current conditions. Sales transactions have risen more recently, but that just got turned off. So how soon will it be before we see zero auctions reported on a Saturday? Third, property investors will continue to flee. They already saw rental returns dropping, now no capital growth. Demand from new investors was weak, it'll die. And they may have to subsidise renters who cannot pay rent due to job losses or income decline. Fourth, existing mortgage holders will face cash flow issues as income stalls. We've already had more than 1 million households in cash flow stress, according to our surveys, but now another 200,000 or so are set to join them in short order. Around 1/4 of households have less than 1 month's free cash available if income stall. Fifth, banks will and it have been cutting back on mortgage lending. With margins already low, experience from Europe suggests it is unprofitable to lend, and they will also lift risk underwriting standards, meaning people, if they want to borrow, will get a lower available loan. Loan books will likely contain more defaults and higher risks, meaning more capital, and some may choose to shrink their balance sheets as liquidity stalls. Recently, first-time buyers were getting $420,000 worth of mortgages, no problem, with income ratios of 6 or 7 or even 8 times or even more. Now debt servicing ratios, of course, are still very high, and servicing is an issue. Income multipliers often assume double incomes. If one income stopped, that would be a big problem. 6, forced sales will eventually occur, though not immediately. I expect banks to support households in financial stress by loan and interest payment propositions for a time, but eventually forced sales at lower than current market values will follow. In addition, given the death rates among older people, perhaps there'll be more supply to come on stream as estates are liquidated. 7th, states will have to take a hit from falling stamp duties as transactions slow, and they won't be able to reverse that. 8th, government will try various stimulation moves to try to prop up the property market, but persuading people to buy now will be like selling seawater on the beach. They may well provide cash support direct to households for mortgages and rent payments, as it is in the UK. They probably should. 9th, the property wealth effect, which was a mirage, is dead, finally, until the next bubble starts, of course, which it will unless policy changes. And I'll have more to say about that in a future post. And finally, it's worth thinking about this. On average, prices are 40% over their fundamental value, so they have a long way to fall. And debt to GDP ratios are and will go farther off the charts. Just in passing, the ABS published a rather irrelevant employment number. They said that the Australian trend unemployment rate remained steady at 5.1% in February from a revised January 2020 figure, according to the latest information. But of course, that was before the current issues, and so it's really irrelevant. And they did actually acknowledge that the impact of the health issues hadn't really come through at that time. So, to my mind, hardly worth spending any time on. And then the Reserve came out at 2:30 and cut the cash rate and also described a number of other initiatives. And they said this is firstly a public health issue, but it is also having a very major impact on the economy and the financial system. Countries have restricted the movement of people across borders and have implemented social distancing measures, including restricting movements within countries and within cities. The result has been major disruption to economic activity around the world, and this is likely to remain the case for some time yet. Financial market volatility has been very high. Equity prices has experienced large declines. Government bond yields have declined to historic lows. However, the functioning of major government bond markets have been impaired, which has disrupted other markets given their important role as financial benchmarks. Funding markets open to only the highest quality borrowers. The primary response to this is to manage the health of the population, but other arms of policy, including monetary and fiscal policy, play an important role in reducing the economic and financial disruption. And then they said, at a meeting yesterday, the Reserve Bank agreed to the following. First, a reduction in the cash rate to 0.25%. And the board will not increase the cash rate target until progress is made towards full employment and is confident that inflation will be sustainably within the 2 to 3% target band. Second, a target for the yield on 3-year government bonds of around 0.25%. This will be achieved through purchase of government bonds in the secondary market. These purchases will commence tomorrow, and the bank will work closely with the Australian Office of Financial Management, AOFM, and state government borrowing authorities to ensure the efficacy of its actions. Third, a funding facility for the banking system with particular support for credit to small and medium businesses. The Reserve Bank will provide a 3-year funding facility to ADIs with a fixed rate of 0.25%. ADIs will be able to obtain initial funding for up to 3 years for existing outstanding credit. They will have access to additional funding if they increase lending to business, especially to small and medium businesses. This facility is at least $90 billion. Further details will be available later. And the Australian government, they say, is also developing a complementary program to support the non-bank finance sector, small lenders, and the securitization markets. And we'll talk about that in a moment. And lastly, exchange settlement balances at Reserve Bank will be remunerated at 10 basis points rather than 0, which was the case under the previous arrangement. This will mitigate the costs to the banking system associated with a large increase in bank settlement balances at the Reserve Bank that will occur following these actions. And they also said that the Reserve Bank will continue to provide liquidity to Australian financial markets by conducting 1 month and 3 month repo operations in its daily market operations until further notice. In addition, the bank will conduct longer-term repo operations in 6-month maturity or longer, at least weekly, as long as market conditions warrant it. And they close by saying Australia's financial system is resilient and well placed to deal with the current effects. The banking system is well capitalised and is in a strong liquidity position. Substantial financial buffers are available to be drawn down if required to support the economy, and the Reserve Bank is working closely with the other financial regulators and the Australian government to help ensure that Australia's financial market continue to operate effectively and that credit is available to households and to businesses. And directly after that, APRA came out and said that APRA announced temporary changes to its expectations regarding bank capital ratios to ensure banks are well positioned to continue to provide credit to the economy in the current challenging environment. Over the past decade, they said, the Australian banking system has built up substantial capital buffers. The highest quality form of capital, the common Tier 1 equity, reached $235 billion at the end of 2019. As a result, banks are typically maintaining capital levels well above minimum regulatory requirements. So APRA is advising all banks today that given the prevailing circumstances, it envisages that they will need to utilise some of their current large buffers to facilitate ongoing lending to the economy. This is especially the case for banks wishing to take advantage of the new facilities announced today by the Reserve Bank of Australia to promote the continued flow of credit. Provided banks are able to demonstrate that they can meet their various minimum capital requirements, APRA would not be concerned if they were not meeting the additional benchmarks announced in 2016 during the current period of disruption. And as the final leg of the policies, and the Treasurer announced a second stimulus plan would be brought into effect hours after the emergency rate cut by the Reserve Bank. The Prime Minister and Treasurer addressed Australia announcing a further $15 billion investment to enable smaller lenders to continue supporting Australian consumers and small businesses. This funding will complement the Reserve Bank of Australia's announcement of a $90 billion term funding facility for ADIs. Government's latest action is aimed to enable customers of smaller lenders to continue to access affordable credit as the world deals with the significant challenges presented. Smaller lenders are critical to Australia's lending markets, often driving innovation and providing competition for larger lenders, Frydenberg said. Combined, these measures will support the continued availability of lenders to support their customers and in so doing the Australian economy. And the Treasurer confirmed that the Australian Office of Financial Management, the AOFM, will be provided with an investment capacity of $15 billion to invest in wholesale funding markets used by small ADIs and non-ADI lenders. This facility will allow the AOFM to support a substantial volume of expected issuance by these lenders over a 12-month period. Importantly, the assets being purchased by the AOFM will not be limited to residential mortgage-backed securities. The AOFM will also be able to invest in a range of other asset-backed securities and warehouse facilities. The government will provide the AOFM with investment guidelines that will outline the basis on which the AOFM is to undertake these investments. And then just to round it off, ScoMo also announced that Australia is going to shut its borders. All non-citizen, non-resident travellers will be banned from entering Australia as the government continues to deal with the medical emergency. The government's reasoning is that a significant number of cases are not contracted through community transmission, but by contact with someone who's recently travelled from overseas. So all in all, this is a very significant set of events. The Reserve Bank has really stepped up and pulled out all the stops. I discussed that on a radio interview this evening. Not only have they cut the cash rate, but they have also started quantitative easing and flowing more liquidity back into the banking system to encourage lending to both households and to small businesses. Of course, the question is, in this environment, are either of those community groups likely to take up more loans? That will be an open question. We'll see how it plays out. And in a way, the Reserve Bank has been mirroring the stimulus packages that we're seeing deployed around the world in a massive attempt to try and maintain the financial system. Now, we can look finally at the movements on the markets and perhaps get a read as to whether these moves made any impact at all. So the ASX 200 ended down 3.44% to 4,782. The financial index fell 7.03% to 3,934. And the real estate trusts fell another 14.83% to 907.10. The volatility index ended up at 52.90, and the ASX 200 futures was up 0.57% to 4,877. ANZ fell 10.76% to 15.10. CBA fell 7.1% to 61.01. NAB fell 9.46% to 14.87. Westpac fell 9.76% to 14.80. The Bank of Queensland was up 0.74% to 5.48. Bendigo was down 1.13% to 6.11. Suncorp fell 12.98% to 7.64. Macquarie Group fell 16.19% to 78.13. AMP fell 3.65% to 1.32. Genworth, the mortgage insurer, fell 31.53% to 1.39. McGrath fell 2.63% to 18.5 cents. Yellow Brick Road fell 7.69% to 6 cents. AFG fell 18.1% to 1.07. Mortgage Choice fell 11.27% to 63 cents. And the Aussie dollar closed down at 57.32 cents, which was down 0.68%. The euro Aussie dollar was flat at 1.8906, and the 2-year bond was down 9.37% to 0.329, while the 10-year bond was down 12.51% to 1.409. The Aussie Gold Cross was up 3.12% to 2,586, and the Bitcoin Aussie Cross was up 9.71% to 9,702. And looking across to the US, yesterday the Dow Jones fell 6.3% to 19,904. The S&P 500 fell 5.18% to 2,398. And the Financial Services Index ended up at 381.20. Goldman Sachs, for example, fell 11.75% to 140.02. The Volatility Index was up again to 98.27. The 10-year bond was down 5.03% to 1.195. And the S&P 500 futures was down 1.05 to 2,376. So you can see there's massive volatility on the markets at the moment, a lot of uncertainty about what's going on. The central bank intervention around the world is clearly having an impact. The question is, will it stick, or will the markets be disrupted further? And I still maintain my position that until such time as we know the outcomes from the health emergency, then the financial markets are going to gyrate for some time yet to come. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.